Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
In terms of consumers around the country, in terms of low and moderate income families in rural parts of the country and in places that are not on Wall Street, they're going to be strapped for money. They're going to receive fewer benefits, they are not going to be receiving big tax cuts, and things are going to be more expensive for them. Everything from how much they have to spend on healthcare, because again, state governments are going to be starved, they're not going to be able to spend as much, to how much they have to spend on education, how much they have to spend on energy, on top of the goods that will be more expensive because of the tariffs.
If you contrast Target's results today to Walmart's last week, you see a stark difference. Target comparable store sales decelerated from plus 1.5 last quarter to minus 3.8 this quarter. Take Walmart. Walmart did 4.8 this quarter from 4.9 last quarter. So no change at Walmart on comparable store sales and a deceleration of 5 percentage points at Target.
Year to date, it's up 15%, and from its April lows when it was around 76,000, just below 80,000, it's up more than 40%. So it has really rallied over the last several weeks, and part of this has to do with a more optimistic regulatory framework, because if you've got that stablecoin bill that's in the Senate, you've got more institutional buying, and also you have what one analyst has been saying, that has been this investor shift to buy the dips. So investors have been buying the dips along the way, sending it to an all-time record high.
We got 1 hour to go until the market close. So we're taking a look at the major averages, all of which are falling. Now you see the Dow down now by 756 points or so, off by 1.8%. The S&P 500 down 1.4%, and the Nasdaq Composite down 1.2%. Now all of them were plugging along, and all of them have one thing in common, and that's this, the big leg downward that we saw at 1 p.m. What happened at 1 p.m.? A big bond auction. There were a lot of eyes on that auction, right, Josh?
20-year. Well, a couple things. One is, I would also argue, Julie, and we have talked about this on the show this week, that you did have technicians, well-known technicians, who were telling their clients, we talked about this, that they were looking at the charts and they were saying, listen, we are overbought. We are short-term overbought. So you are primed to take a breather. To your point, I think you now have the reason to take a breather in terms of the action you're seeing in the bond market. It's not just the move in yields. Your benchmark 10-year, it's back above 4.5, right? It's not just that. It's the way they've gotten there, the speed they've gotten there. That's causing some headlines and some focus, and obviously calling into question what that means in terms of headwinds for the equity market.
Yeah, so here's the month-to-date chart of the 10-year. So speaking to your point about the speed with which we have gotten there, you can look at the same chart for the 30-year, and we're back above 5% there. We haven't been there for a while. This harkens back to the Moody's downgrade that we got late Friday that caused yields to momentarily spike, and then they came back down. The core, the crux of all of this question surround around who is buying U.S. Treasuries, and is there going to be less appetite for that buying? And so that's why the auction today was closely watched. Now we've talked to a lot of people, I'm sure we're going to talk to a lot of people who say there's no real fundamental threat to foreign appetite for U.S. Treasuries. However, there are some, jitters in the market around it, especially as Congress debates a big spendy tax package right now.
And we'll have more on that headline as well. Some interesting just kind of moves in the market. I think big tech has certainly been in focus. We're going to talk more about that in a second. You can see how some of the sector reaction here.
Broad sell-off, I think, is the point that I wanted to make by showing the sectors here today. Real estate, healthcare, consumer discretionary doing the worst, but everything is selling off today. And then to get to big tech, one of these things is not like the other. One of these things stands out today, and that's Google, up 3.4%. It fell yesterday after its I.O. conference, but now investors taking another look. They like some of the AI announcements that came out, but there is another stock where maybe there's a little concern about AI.
Yeah, that is real. I mean, look at Apple down 2.5%. That's a significant move, and it's weighing on the indexes there. So let's get more on that, because Sam Altman's OpenAI announced on Wednesday that it is acquiring Johnny Ive's AI devices startup for over $6 billion. Ben Beharin, Crave Strategies, CEO and principal analyst, joins us now with more. Ben, it is great to see you as always. So let's start just big picture, Ben. You saw that headline. That is a big price tag. It's big personalities. Sam Altman, Johnny Ive. Investors may be questioning what long-term could this mean for Apple. I'm just curious, longtime Apple watcher, longtime tech analyst. You saw that headline. What was your reaction, Ben? What'd you make of it?
Yeah, I mean, I think anybody who's been tracking the space knew that there had been signals that OpenAI wanted to get into more hardware. So I think them, acquiring a team and obviously a set of visionary thinkers and engineers who can go and develop new what we just kind of loosely call AI hardware, AI first hardware. It's sort of a loose term, but these idea that a next generation of devices is going to be running on the back of these foundational models like OpenAI has, like Google has, et cetera. So I think it's smart. It makes a ton of sense. There's still obviously a lot of work to be done there. Just because you've got hardware expertise doesn't necessarily mean that you execute on it. But I think that the main point is OpenAI has one of the best foundational models out there, which I think is key to delivering an AI experience in hardware. So they've got all the right pieces, and they're adding to that with this acquisition.
And talk a little bit about, listen, part of the reason that headline drops and it gets so much attention is because it is Sir Johnny Ive, right? And talk a little bit about that, because listen, people, maybe they don't follow Apple as closely. They don't know all the key characters and personalities and lieutenants. Johnny Ive, so instrumental in so many of the products a lot of viewers probably have in front of them right now. You talk about the iPhone and watch, iPad, iMac. He was Steve Jobs' right-hand man. Just walk us through briefly, Ben, a little bit about Sir Johnny Ive, his impact, his influence.
Yeah, I think he was a critical part of the design process, right? I think the entire team that was involved with a host of Apple products, and Johnny Ive was a part of that, had a whole slew of perspectives, opinions on what makes devices elegant, what makes them useful, what makes them simple to use. And he was a key part of that team, right? And I think that's why, he's been sort of propped up as, with the role that he had within Apple, just to make the kind of devices that everybody loves and delights with from a hardware perspective. So obviously believing that this now combination with, Johnny Ive and Sam Altman and that team, this now fusion of sort of next generation AI software and these leading edge models combined with the kind of hardware that people will want to use, right? Feel good about, having on their person, if these are glasses or pendants, whatever, shape they take. You got to make stuff that people, like and aren't ashamed to wear because it's ugly. And so he was a huge part of that, right? In designing hardware product and experiences that obviously helped fuel Apple to what it is today.
And Ben, when we look at the moves that OpenAI has been making recently, they've been hiring sort of on a bit of a hiring blitz, right? They hired the Nextdoor CEO as their CFO last year. They recently hired the Instacart CEO as, I believe, their chief product officer. Now there's the Johnny Ive move. But what does all of this tell? It still takes a while to make hardware, right? It's not like they've hired him and that's it. What kind of timeline can we perhaps look for something like this?
Yeah, you're totally right. It takes a lot of time, and just look again, right, at how long Meta had been doing hardware, right, to get to a point where we saw some tipping curves of mass adoption, right? The glasses had been in works for a long time before they made it to market, and it was really the second generation of Meta Ray-Bans that moved to any kind of reasonable scale, with those now having sold over, a little over 2 million units. So there is a lot of time that goes into this. What we don't know is how far along OpenAI is already with prior concepts. If they've been trial and erroring in this for a while and they're closer than we know because of what they got hardware-wise, then obviously bringing more of these assets to the team can put them on a shorter timeline. I don't think they're starting from scratch where it would be longer, but I also think we got to look at the timeline for. Again, just let's look at what Google, showed yesterday with these kind of AI first glasses, whether they have a display or not, right? Like the Meta Ray-Bans that don't have a display, or some of the others that are being floated with a display. we're on the cusp of those starting to take off, fueled by your ability to talk to an AI agent, explore the world, let it see what you see, and have those interactions. That's the 12 to 18th month journey that we're on. You're going to see a whole host of those, whether OpenAI's in that or not. But I would say over the next 2 years, this space is going to heat up quickly, and we're going to see hardware innovation again with this AI first, sort of wearables hardware.
Really interesting stuff, Ben. Looking forward to continuing the conversation in the coming months as we get more news on this. Appreciate it.
Yeah, thanks for having me.
House Speaker Mike Johnson appears set to unveil changes to President Trump's quote-unquote big beautiful bill today, including a more generous deduction for state and local taxes. Here with more is Yahoo Finance's Ben Werschkul. So where are we, Ben, in this whole process?
Yeah, Julie. So we're at crunch time here in Washington. There's a lot of issues. You mentioned the salt deduction was a big change today. It's going to $40,000 in the bill from it's $10,000 annually currently. Johnson's initial offer was $30,000, and he's upped it further to $40,000. We have signs that the Salt Caucus is in favor of that, so it may help take that issue off the table. But it's shifted the focus to fiscal conservatives who are meeting with Trump this hour at the White House to try to work out their range of issues there. And this is the largest and the most kind of immovable so far, at least, group in all these negotiations, with way more than enough members to sink this bill if they want to. And it comes as Trump and Johnson want to have a vote on this as soon as tonight. The issue on a policy front here for Johnson is that giving into the fiscal conservatives on some of the additional cuts they want on issues like Medicaid could sink the bill with moderates. So what the playbook appears to be right now on this group is essentially hardball. So I think this is a meeting that's going to have a lot of arm twisting, a lot of forcing. This Freedom Caucus went into this meeting saying the bill's not ready. They're not going to vote yes today. They want more days to negotiate. We'll see what the tone is coming out of the meeting in the next hour or so.
All right, Ben, thank you. Appreciate it. Well, stocks mixed with just under an hour to go to the closing bell on Wall Street. For more on the latest market moves, let's welcome in here Doug Pita, BCA Research Chief, U.S. Investment Strategist. It's good to see you, sir, here on set.
Thank you very much, Josh.
Let's get to what Julie and I were just talking about, which is this move we're seeing in yields. Benchmark 10-year back over 4.5. It's not just the level. I think it's the way we got there, the speed we got there. Why have we seen, Doug, this move, in your opinion?
It seems to I and my colleagues at BCA, especially from talking to global investors, because we have clients the world over, that there's a real concern about investing in the United States. And there's a revisiting of the safe haven status for U.S. Treasuries. There is a revisiting of the U.S. dollar also being a safe haven currency. And I can tell you, I was in Toronto last week for 2 days. In every single meeting, I was asked about de-dollarization. What do I think, what does BCA think about the notion that investors should diversify away from the U.S. dollar?
What'd you tell them, Doug?
Here? I told them it's too soon to tell if this really has legs beyond the near term, but just this week, now as we debate the tax bill, and it appears that there are going to be more tax cuts, but less spending cuts than expected, well, all else equal, that means the deficit grows. Mm-hmm. And if the deficit grows, then Treasury yields ought to rise. So the debate in Congress right now is really adding fuel to the fire of the sell-off in bonds.
And as you say, there is a lot of chatter around de-dollarization and around assets coming out of the U.S., or just, if not coming out, not coming in as much. There is less concrete evidence that it is happening and will continue to happen. So how should we view that auction today? Is it a sign that, or is it just a kind of one auction and we would have to look at a whole series of auctions?
I lean more towards the latter, that it is one auction. We have to look at other ones, because the 20-year, right, when we talk about benchmark Treasury yields, we talk about the 10-year, we talk about the 30-year. The 20-year is sort of in this no man's land. There isn't a ton of institutional demand for 20-year paper. Mm-hmm. So I think this is one small data point, but it could easily be overwhelmed if we have a solid 10 or 30-year auction in the coming weeks. And if we do, this will be completely forgotten about.
I want to ask about de-dollarization for a moment, right? Or the view that we could see a weakening dollar not be as much the reserve currency globally. And I know that when we look at dollar, there are advantages for some companies, for example, if there is a weaker dollar. There are disadvantages. So how should investors who are not as well versed perhaps in the world of currencies think about where the balance of risks lie?
Absolutely, there are puts and takes. So if you're a multinational based here and you sell goods in Europe or Asia or anywhere else in the world, when you translate those revenues back into the dollar, if the dollar is weaker relative to the currencies where you sold the stuff, you make more money, right? It drops more to the bottom line. But like you said, there are a lot of puts and takes in there. If the dollar falls and you have a lot of inputs, a lot of costs in the rest of the world, then that hurts you. Look, the way I think of the de-dollarization, I had a colleague who was in Europe 2 weeks ago. He said in every single meeting he was asked two questions. One, is there a possibility that the United States is going to impose a tax on inbound capital so that you would be charged, say, 1% or 0.5% or 0.25% for any investment in treasuries? Then two, he was asked, what's the possibility that the government is going to, the US Treasury, is going to force a conversion of, say, a bond I own that now is a 10-year with a 4% coupon? What's the possibility that the US says you're going to have to convert this into a 20 or 30-year bond with a coupon less than that 4% 10-year coupon?
And those seem like insane questions.
They absolutely do.
In a normal world.
Utterly inconceivable before January 20th. But these were written about in White House advisor Stephen Moran's paper called like a user's guide to fix the trade deficit when he was running a hedge fund. And people read that. Those were two provisions that were in that paper. Absolutely inconceivable ideas. They would be technical default. If you were to say, all right, we're going to extend the maturity of this bond and we're going to pay you less than we said at the beginning. That's crazy talk. But just the fact that people are vocalizing these things, professional institutional investors around the world are speaking this stuff. I'm of a mind that once it's said, it can't be unsaid. You can't unring the bell. So if we really have opened Pandora's box with this sort of talk, then what I think it means for everyone, be they equity investors, bond investors, retail investors, professionals, is that you should assign a greater amount of risk to investing in the United States than you did before we had this sort of talk.
And in terms of how you want to be positioned then, Doug, that means what? I want to get more defensive?
Absolutely. That you want to position more defensively. So you own T-bills instead of going further out the curve. You own, within equities, you own utilities instead of owning more go-go, more cyclically exposed spaces. You reduce your overall exposure to equities. And perhaps there's an opening here to diversify away from the United States, be it equities or be it bonds.
One other thing I want to ask you about is if you take the other side of this, you say everything's going to be fine, we're going to grow, we've got the tax cut coming, that certainly is what the administration would argue. And if you look at the hard data right now, it's held up pretty well. And I know that's something you're watching closely. The soft data has deteriorated. The hard data has not. And again, the bulls would say Americans keep spending, and they have kept spending. What would you say to that?
There's no doubt about it that the hard data have been solid. And it's the survey data, what we call soft data, that have really crumbled. Like they're dire, whether it's businesses or households. And all else equal, you'd rather watch what people do than listen to what they say. However, the hard data is really in the rearview mirror. The soft data is what households and businesses think they see through the windshield. Now, it's not etched in stone that what they think they see coming up is what is actually going to be what's there, right, when we travel those remaining miles. But I do think it's a warning because it's more forward-looking. And I would additionally say consumers don't have the buffers around them that they have had ever since the spring of 2020 when we got monumentally large fiscal transfers from Congress to Main Street and when we got a return to zero interest rate policy and even new Federal Reserve programs to ease monetary conditions. Those are now wearing off. I like to say the long half-life of the pandemic stimulus is finally wearing off. So when that buffer provided by the stimulus was around households, they were able to keep spending even though we had high inflation because they're sitting on a mountain of cash. But by our best analysis right now, that amount of cash is gone. And additionally, this is only at the margin and not everybody has student loans, but now student loans that you didn't have to pay for the last 5 years, now there's a new pot of debt that households have to service. And mortgage rates are only going to increase every time there is a new transaction, because anyone who owned a house, who sells it now, who's going to need a mortgage in the next place, is going from trading in roughly a 3% mortgage to something between 6.5% and 7%. So there are new pressures on households that weren't there and haven't been there for the last 5 years.
Right, really interesting stuff. Doug, thanks so much for coming in.
Thank you,
Appreciate
Joy.
it. We're just getting started here on Market Domination. Coming up, as progress on a new U.S. budget and tax bill unfolds, concerns over the economy coming into focus. We'll dive into the latest on the other side. Stick around, much more Market Domination still to come. As progress unfolds on a new U.S. budget and tax bill, concerns over the economy pulling into focus, from U.S. deficit worries to trade uncertainty, markets remaining on the edge of their seats for the next clues on future impacts to the economy. Here to discuss this and more, Vanguard Global Chief Economist and Global Head of the Investment Strategy Group, Joe Davis. Joe, by the way, happens to be at the NASDAQ today, where they are marking Vanguard's 50th anniversary, and Joe also happens to have just released a book. So you got a few things going on, Joe. Thank you so much for making time for us today. Appreciate it.
Yeah, thank you for having me.
So let's talk, first of all, big picture about the economy here. And, we have seen this round trip in the markets. Should people think about the economic outlook as having made a round trip as well? Are we seeing markets accurately and fairly price in the economic outlook right now?
Well, I think so. I think more so than where they had at the beginning of the year. I mean, clearly we've seen a lot of variation in trade policy. Our projections moved around from the beginning of the year, assuming some tariff rates. We, of course, saw materially higher tariff rates and uncertainty in terms of policy. And, of course, some of that has retraced. Our outlook is still generally the same. We do not have recession as a baseline. The odds are only roughly 25 or 30%. I think that's a testament to some of the resiliency we see from the U.S. consumer and businesses. But to be clear, the labor market has slowed, and we still have yet to see the full effects of some of the trade shocks earlier in the year.
Joe, I also want to get your take on the story of the day for investors, which is what we're seeing in the bond market. Week 20-year auction, 10 years back above 4.5. Joe, what's moving these yields back above 4.5? Joe, what are the reasons, and what do you see from here?
Yeah. Well, in our analysis, it's one thing, and that's really structural deficits, which means fiscal deficits that are continuing at a pace, in actually an expanding economy. It was one of the reasons why we even released the book that's released today. We talk a lot about the significant headwinds that fiscal deficits in the United States could serve on the bond market and hence equity markets. It's really a secular issue, but it'll have increased importance in years to come. So the recent headlines, I am not surprised. And to our framework, this is not a shock to us.
Do me a favor, Joe. Can you spell out for people who are watching, viewers who are watching, who are not as steeped in the arcana of the bond market, why this is so important? Because for years we have heard concerns raised about these deficits and the potential effects, and we haven't really seen those come to fruition. Why might that happen, and what could they be?
Sure, so I'll give you 3 points. One is, for anyone who hears the phrase deficit, that's just a gap between the taxes that a government brings in and then what is it spending on social programs, national defense, and interest costs. A deficit, obviously, you're spending more than you bring in. During recessions or periods of war, we've seen very high deficit levels, and they don't necessarily have any impact on interest rates. They're generally viewed as temporary, unfortunate events if it's a war or a recession, but they don't have this permanent effect of the debt levels growing at an increasing rate. However, if it's what economists call structural, which means every year, whether the economy is strong or not, we have deficits growing. And part of the reason for that is, we have strong commitments from Social Security, Medicare, and Medicaid, and we have tax rates that don't fully cover those costs. And so in our framework, that is what can have an impact on interest rates, higher borrowing costs for the Treasury to issue debt, and then all the interest rates tied to that, mortgage rates, auto loans, and so forth. Again, we're not at alarmist levels yet. I don't think we'll be there tomorrow, but we started putting our finger on this dynamic 2 years ago. And so if we do not see a stabilization in our deficit levels, we could see further upward pressure on the bond market. And that's precisely the scenario we talk about in the book released today.
Joe, one of the interesting things that, and unusual things that Vanguard does, which is very Vanguard, but not very much the rest of the street, is you guys look out 10 years. And you provide 10-year forecasts for different assets on an annual basis. Yeah. And so you all are looking at 10-year annualized returns for equities in the U.S. of 4.3% to 6.3%. And I guess I would ask how this deficit issue feeds into that, if at all, and if that is a negative potential effect on stocks. What are then some of the positive long-term effects that are going to continue to buoy U.S. stocks?
Well, I think, again, yes, the deficit issues and other things, if it affects interest rates, then it affects the equity market. And so what do we have? And that's we were very guarded on the stock market this year. We have the market's pretty frothy going into the year, so which means valuations were high, right? Investors were optimistic. Yeah, we also had interest rates that, in our judgment, were certainly unlikely to come down materially. And now you have a little bit of these budding fiscal issues. And so when you have interest rates rising, the cost of financing for companies goes up. I would say just the risk-taking behavior of financial participants goes down. And so you generally have some depressant on equities, but it may not be permanent or long-lasting, but you do see that. And so the irony of if we have a spike in interest rates, it's not our baseline, but if we would, you'd have greater risk in the equity market than in the fixed income market.
Joe, investors are also just very closely watching, of course, Trump's tax bill. Of course, that's generating a lot of headlines and drama today. Let's say we do push that over the finish line, though, Joe. What does that mean for the economy?
Well, we were anticipating effectively extension from some of the legislation passed in 2017. That won't really materially change our fiscal deficit assessment. I think it would have to be a material surprise, more restrictive or more generous from that, I think, to really affect the bond market. I think many expect an extension, and so that wouldn't be a material surprise. So it wouldn't materially change our outlook. But I tell you that again underscores our secular themes have been, market themes have been, there's equity market risk, particularly in the U.S. Investors need to diversify, have some diversification outside U.S. equity markets, the overseas or non-U.S. dollar international equity markets. Now, again, we've said that for 3 years. The last year or two, we looked out of touch, but it was our assessment of the U.S. currency and some of these fiscal dynamics. You say you want to have some diversification there and not have all your eggs in U.S. stocks. And so our conviction on that view is only growing.
Joe, great to see you and to have you on the show today. Thank you so much for joining us. Appreciate it.
Thank you for having me.
Stick around. Much more market domination still to come.
Global markets recalibrating around trade tensions. They have many investors rethinking how and where to allocate capital, particularly outside of the U.S. in emerging markets. We're navigating how to play the space with the Yahoo Finance playbook. Joining us now, Jason Su, CIO and founder at Rayliant. Thanks so much for being here.
Glad to be here.
So we've had this whole big discussion about the U.S. Not as many, perhaps, investors as interested in the U.S. International markets have been starting to gain a little bit of steam here. So before we get to sort of some specific ideas within emerging markets, talk to me, first of all, big picture, how you think about the emerging markets right now versus investing in U.S. or in other developed markets for that matter.
Yeah, so I would say for the last 15 years, right, if you believed in international diversification, bought into the EM growth story, you'd be hating yourself right now, right? Because the U.S. absolutely trumps emerging markets. But there was a 10-year prior to that where EM outperformed the US by 9% per annum for about 10 years running. I think that cycle is coming back. So for those who are under-diversified to EM, to US home country bias, I think this is time again to look at EM. I think the big AI super cycle and startup super cycle is deploying hardware everywhere. Asia has always been hardware, and that's led by EM Asia.
Let me ask you, Jason, I'm curious, what if on this trade fight and this tariff fight, Trump really hasn't retreated at all? What if he's really just called a truce? It's like a temporary reprieve. He just built a little window in where he'll try to punch through this tax bill. And as soon as the tax bill gets punched through, and he doesn't see Xi and others giving him the kind of concession he wants, hey, he just brings down that tariff pain all over again. Would that change your outlook on EM?
Yeah, so if somehow President Trump is more of a purist when it comes to having no trade deficit, then I think it's quite scary, right? And I think this is bad news for Asia. But I don't think he's that, right? He's very practical. I think he's moved on from the trade war, right? He is now in Middle East telling everyone in Middle East loves me. They're kissing my butt. They're giving me airplanes and big deals and buying Boeings. You know, I think he's way past.
He was in his element, Jason.
He was
doubt.
awesome, right? So,
sure.
so I think he's moved on, and he doesn't want to drag out this fight with Xi because he realized he probably didn't get very much from all that work. So I am really not very concerned that we're going to go back to a round two.
So if in fact that's the case then, so if you're looking within emerging markets, what kind of criteria are you using? What kind of names are you looking for that might benefit from that AI hardware cycle you're talking about?
So first of all, I mean, I think you want to focus in the tech sector. And so in a lot of emerging markets, right, it's actually a lot of boring, stale enterprise, giant financials. That's not where you want to fish right now. So it's quality tech companies that have always had superior tech leadership, manufacturing capabilities. That's where you really want to look. And of course, Asia is trading cheap, especially China is trading very cheap coming out of COVID. They've just had policy mistakes after policy mistakes, bad sentiment. So this is a great place where value stocks are about to hit some catalysts.
And some names, Jason, that I know you like. Alibaba. You look at that one, you say that's attractive. That's an opportunity. How come?
So first of all, I mean, in some ways, Alibaba has become synonymous with China. So most of us, when you say, oh, what is one stock you can sort of recall when people say China, they probably say Baba, right? What a great ticker. And so in some ways, when people go, you know, maybe it's time for me to bottom fish and sort of bet on the recovery of China, I think Baba just being synonymous with China is going to benefit a lot from there. And of course, you know, I think Baba's got so many things going on with Jack Ma being in the good grace of Beijing again. I think that's always a positive. So that's one reason we like Baba.
And the other one that you like is BYD, which has certainly gotten a lot of attention. The sales in China have been strong. What do you think the future looks like for that one?
So one thing people probably don't realize is, you know, China now exports more cars than Japan, so it's the #1 car exporter, and BYD has become one of the very big, right? I think BYD is going to be Toyota in the future, just in the EV space, and that is tremendous growth opportunity. You know, I think they have a leadership position right now in autonomous driving. Obviously, you know, testing out driving conditions in China. If you can drive autonomously in China, you can probably drive almost anywhere, and so that's why we really like it. It is, I think, the Toyota of the future, and its sort of leadership in autonomous driving, I think that has tremendous value.
Jason, great to see you. Appreciate your time in those picks. That was great.
Absolutely.
Well, a more hopeful outlook for Tesla emerging as CEO Elon Musk refocuses his attention on the EV maker, Musk stepping away from his identity as an influential political operator as Tesla faces weakness. The company reporting last month its worst quarter for sales in 3 years. For more now on what's next as Elon Musk enters a new phase, let's get to Gerber Kawasaki Wealth and Investment Management CEO Ross Gerber. Ross, great to see you. So, listen, a lot of places we could start with this one, Ross. Maybe, you know, you look at Tesla. I know it's down today, Ross. It's in the red. But what a move for that stock. I mean, you're up about 50% from early April. I'm curious what you make of that move, Ross, and what you would chalk it up to. Is that, you know, is that Musk saying, I'm going to spend more time at Tesla? Is it easing trade tensions with China? Is it, hey, robo-taxis on the way in Austin? Is it all three? Something I'm missing? Walk me through it.
Well, I think the first two you're dead right on. I don't know about the third because it's really hard to quantify the economics behind launching a robo-taxi service, and we certainly don't think it's going to be accretive to earnings like for years. So it took Uber almost a decade to make money in the ride sharing business, and I don't think it's a very easy business. But I think the other two issues were major issues for Tesla. First of all, Elon wasn't working at Tesla. The company was adrift. It was a really big positive to see him back doing interviews from the factory floor. He kind of got the message, like, you need to show up to work because it's like the company desperately needs it. So that certainly helps boost the stock, because whatever Elon's focused on is, he usually gets results. And then secondly, the China thing is a huge problem for Tesla, because Tesla is really an important company in China, and it's an American symbol in China, like Apple. And I was very concerned that this would, potentially blow up into a full trade war where, the boycotts that we're seeing here in the United States and Europe would extend to China even. And so, I'm pretty happy to see the trade, I wouldn't say be solved, but simmered off a little bit. And it was a direct benefit to Tesla to have Chinese tensions ease. So that did bring the stock back up, but we're now at a valuation that's well beyond even Tesla's traditional, 100 times forward earnings. So, for investors who are concerned about Tesla's future, it's an opportunity to let go of some of the stock.
Which I know is something that you've been doing, Ross. I also thought, I was struck by some of the comments that we heard from Elon Musk when he was speaking to that conference in the Mideast. And among other things, he said he was going to pull back from his political giving. I guess unless he sees the next opportunity to do political giving where he wants to.
Right.
But I have to wonder, with his sort of backing off of Doge, recommitting to Tesla, and he also made the point that they might have lost customers on the political left but gained them on the political right. Where do you think this sort of brand goes from here, both in the U.S. and also in Europe?
Well, clearly, Elon's trying to minimize a reality that exists right now, which is Tesla sales are going down. And they've been going down substantially, even more this quarter. So, there's a little bit of this denial going on of the effect of his political actions on and personal belief systems that he's amplified on the actual brand. But the brand is probably one of the most hated brands in the world now, unfortunately. And for a company that does so much to try to make a difference in climate and for human life in a positive way, it's extremely distressing to me how negative the brand is viewed today. And I don't think he made any attempt to try to reckon with that at all. So I don't know how that solves itself. And I think until Tesla continues to see weak sales, which I think it will, at some point they'll need to address this.
Ross, a final question, just your point about self-driving cars being a long-term trend, and it's well taken. I do wonder whether you think, and I don't want to overstate it, Ross, but whether you think something might be shifting there. I mean, I was just struck by this, the Waymo co-CEO telling reporters this week they have reached 10 million trips, doubling in the past 5 months. As an investor and a longtime tech investor, Ross, are you excited about that trend? Not in the near term or in the intermediate term, but 5, 10 years out. And how do you think about Tesla's potential role in it?
Well, this is kind of one of my favorite things to do as an investor, is really try to brainstorm, what does this future really look like when you think about it from a more human perspective, not what the tech people expect us to do, So there's two issues here. One, Waymo is incredible. It's doing an incredible job. It drives safer than humans. It's incredibly effective service, and we see them as the leader in robotaxi, and they're rapidly expanding, and people love the experience with Waymo. They're doing phenomenally well here in Los Angeles and the Santa Monica area. You see Waymo's working nonstop, and I have yet to hear anybody say anything bad about it, and we talk to a lot of Waymo customers, so Uber really has to worry about Waymo for sure. Secondly, there's no doubt in my mind that Waymo has solved robotaxi in a way that makes driving safer, where Tesla has not yet. And this is an important difference, because until you can make the car safer than humans, driving, it's really hard to get mass adoption of sort of not driving. So, in my mind, the robotaxi's been solved by Waymo, and Tesla should look at what Waymo's doing, and in a lot of ways they're copying them. And I think eventually we'll see very big similarities between what Tesla's doing and what Waymo's doing, especially with the hardware on the car, which Elon's going to have to admit at some point isn't adequate for real safe full self-driving. So the real issue is, are you going to give up your car and the convenience of having a car whenever you want it to do errands and drop off your kids and pick up the dry cleaning and then go stop by the beach for a run? And, you know, like, people, this is a symbol of who you are and your independence. And I personally don't see myself giving up driving because I love cars and I love driving. And I asked my kids this, like, you know, because my kid's like 13 and I'm like, you know, should I teach you how to drive a car, or are you just cool like taking robocabs your whole life? And he looks at me like I'm nuts. He can't wait to have a car, you know? So there's a part of the human behavior here that I think isn't going to change. And even replacing the vehicle fleet would take 20 years. And Elon told me that himself many years ago when I asked him. And so I just don't see robo-taxi expanding the market for taxi services substantially on the near term at all. So it's really a competition between Uber, Waymo, and Tesla in the end to get your ride service needs done. But how does this market really expand? That's the big question. And I'm not sold that humans are giving up their cars.
Ross, always good to see you. Always good to have you on the show. Thank you.
Yeah, thanks for having me.
Stick around. Much more market domination still to come.
President Trump has taken aim at some companies in recent weeks over possible tariff price hikes. But what could Trump do if he's serious about trying to make companies, quote unquote, eat the increases? Here with more, Yahoo Finance's Ben Werschkul. So how could he sort of make good on some of his threats, Ben?
Sure thing. So President Trump has offered kind of harsh words for 4 retailers so far. Around tariff price hikes: Walmart, Amazon, Ford, and Mattel. And the strategy so far is kind of a public pressure one, a kind of so-called name and shame. He told Walmart, "I'll be watching." But what I looked at for this story is what options are available to the president if he decides to go further. And the bottom line is there's quite a few. Experts point to things like a Federal Trade Commission investigation by sector, other government investigations around issues like specific products and or profits, Capitol Hill legislation. There's some ideas there. And then the big one would be price controls via executive order. The interesting thing about all these tools is that if Trump were to avail, and him and his folks aren't saying whether any are under consideration, the man he might have the most to thank for this is Joe Biden, because a lot of these are tools that the Biden administration availed themselves to for very different reasons. They essentially stress tested them around charges of price gouging during inflation. There was an investigation on meat packers, for example, that could be very similar if Trump were to go further. And this is all part of a larger trend. There's an economist at the Cato Institute named Ryan Bourne I spoke to for the story, who talks about sort of a bipartisan push towards increasing government intervention, especially on prices. It's essentially a building up of government, both the bureaucratic and the legal apparatus, to be more involved in private business pricing decisions. How this specific with Trump plays out remains to be seen. Again, the Trump administration isn't saying that they're pondering this beyond the kind of "I'll be watching you" message that they're sending. But Bourne and others make a pretty convincing case that interventions by companies could become more common in the years ahead because of what they're building up in both the Biden and the Trump administration.
Ben, thank you. Appreciate it.
Okay.
Lowe's delivering on subdued expectations for the first quarter amid pressure and demand. This comes after rival Home Depot's mixed earnings results. With more on what this means for the home improvement market, let's get to Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon to you both. Certainly what we heard from both retailers is that discretionary DIY demand is still not as strong as what it used to be, and consumers are taking on less big projects. We also heard there was a slow start to the spring season because of this poor weather in February, and all in the background we have those ongoing challenges around the housing market, as well as higher mortgage rates. They're persisting, higher interest rates are persisting that are putting off large projects, and this uncertainty around tariffs are certainly lingering. One source telling me, quote, "We see positive takeaways from both earnings reports, but we are not fully recovered just yet." And if we take a closer look at same-store sales growth, you see this reverse this past quarter from both Lowe's and Home Depot after a positive uptick in Q4. Now, Lowe's main business is here in the U.S., its whole business. We did see same-store sales fall there. Home Depot also saw same-store sales growth fall as well. But keep in mind, Home Depot also has this mega Canada, Mexico, as well as U.S. business. And here in the U.S., it did see a slight uptick. Something to watch out for, though, here is CFO Brandon Sink, that is of Lowe's. He did say on the call this morning that the chain has yet to see those shoppers re-engage in that discretionary categories. But he said, hey, trends aren't getting worse. We're seeing a lot of the same here.
And what about the messaging around tariffs? Because as we just heard from Ben Werschkul, that's now has some political overtones as well.
Right. Many retailers touch and go on if they should say that they're going to raise prices here. And so what we heard today from Lowe's, they said that roughly 60% of sales originate here in the U.S. They also said that if, hey, something doesn't make sense to have on the shelf anymore, they will go to eliminate that product. We heard the same thing from Home Depot yesterday. And they also said that they're seeking to limit their exposure to China here. A far similar tone to what we heard from Home Depot. So these home improvement retailers sharing a similar tone when it comes to tariffs. What we heard on Tuesday from Home Depot is that more than 50% of purchases are sourced in the U.S. They also said something interesting here. They said that in 12 months, no single country outside of the U.S. will represent more than 10% of their purchases. So really thinking strategically about their supply chain here. Home Depot came up front and center, and they said they have no plans to raise prices. Of course, after that major pushback from the president that we saw over the weekend when it comes to Walmart.
Very interesting.
Lots to follow here.
Yeah, definitely. Thanks for keeping us posted on all of it. Appreciate it, bro. Well, Target shares sinking today. The company reporting first quarter earnings and cutting its sales outlook due to tariff uncertainty. For more on the state of the company, let's bring in Michael Lasser, U.S. hardline, broadline, and food retail analyst at UBS. Michael, thank you so much for joining us. I actually want to start at the top of Target, because today we also learned that the chief operating officer, Michael Fidelki, is going to lead a new group at Target. They're calling it the Multi-Year Acceleration Office, which is focused on Target moving faster on some of its growth priorities, just basically trying to break this cycle that it's been in. But is this also a signal that maybe things need to change at the very top of the company? Is this a signal about Brian Cornell at all? How should we be reading this?
The way you should be reading this is indeed there should be change throughout the organization. Clearly, in the first quarter, Target lost share to a host of retailers. And the encouraging news is that it's saying this is not acceptable. And the reason why it needs this acceleration office is because retail is changing faster today than it ever has in the past. Target most likely got complacent for a period of time. It was working, it was doing well, and it was holding its own. Now it is falling behind. So it is doing things like seeing if it can implement new technology projects faster than it originally expected, changing some of the assortment quicker than what it once did. We think that ultimately this will usher in change, which will be good for Target, and improve Target's positioning in the market, which will be good for the stock.
So if I put you in charge, Michael, you're CEO of Target now, what specific moves would you make?
I do two things, Josh. Number one, Target needs to double down on some of what made Target unique in the past. For example, the limited time offers in partnership with key brands like Kate Spade, Champion, others that it's done in the past. That is what consumers go to Target for. Launching new private label brands like Good and Gather. It needs to keep delighting and surprising the consumer. Second, Target also needs to do a better job of execution. What that means is having the stores stocked well, engaging in good customer service, ensuring that end-to-end experiences for the consumer are really positive. The switching costs for retail today are incredibly low. All you have to do is open a new browser, turn on a new app, go to a new store. So it's really hard for a retailer to maintain loyalty. What will enable Target to do better is stick to what it is, which is a surprise and delight retailer, and do a better job of executing with the core foundational experience for the consumer.
So I guess then the question becomes, Michael, can specifically CEO Brian Cornell do that? Do you think that, after his tenure at the retailer, he's done it in the past, is he the right guy to execute on those items that you mentioned?
I think you answered the question in that Brian's got a history of making change, and time will tell the degree to which he's well positioned to make change here. I think Target will get back to the Target that it has been of old. It's just going to take some time. What is important here is that this has been a wake-up call for Target, that it cannot sit still. The status quo cannot prevail. It is not acceptable what Target's been achieving in the last couple of years. And so time will tell if the right team is in place to be able to effectuate change. I believe that this current team can generate improved performance and be able to fill the potential that Target offers in the market.
Michael, great to see you. Always
Good to see you,
appreciate your
Josh,
time
as
and your
always.
analysis. Thank you, sir.
Likewise.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.